Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. We're excited to be here as always. It is Watchlist Wednesday. My name is Bryce, and as always, joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. It is Watchlist Wednesday, but more importantly, it is your 30th birthday.
It is my 30th birthday.
You're getting old. I've got some AusBiz balloons for you here, nice. Which I'll present to you afterwards. I'm not going to sing happy birthday to you, but happy birthday, mate.
Why, thank you. Thank you very much. Let's get on with the show.
Let's get on with the show.
I appreciate the sentiment. Really love the half-inflated balloons. That's nice.
That's all the air I had in my lungs.
Thank you. But look, it is Watchlist Wednesday, and as always, we're joined by an expert to go through 3 stocks on their watch list. And we're very excited to welcome Luke Larrative to the Equity Mates show for the very first time. Luke is the CEO at Seneca Financial Solutions. Apologies. And he joins us now. Luke, welcome.
G'day guys, how are you? Happy birthday, Bryce.
Thank you, Luke. You've joined us at
like Hamish and Andy.
True. Let's not start that.
Yeah, let's start that. I like that.
No. Let's not start that. So, Luke, we've got 3 stocks on your watch list. Many of our community have heard of 2 of them, I'm sure. Maybe not so much the third, but let's start at the top, and that is with ZipCo. We recently interviewed Larry Diamond, the CEO. Ticker is Z1P. $4 billion market cap. It's down 47% from its year-to-date high, which is probably burning a few members in our community, unfortunately. But why is it on your watch list?
It's on my watch list because it's an interesting stock for starters. I really like the management team. As you guys probably learnt the other day, Larry's a pretty impressive guy. And certainly he's built an amazing business since I first met him before the IPO, and we put our initial investment in back then. So we've been a shareholder for a long time. So it's been on my watch list for a while.
Nice.
But I think right now it's interesting for investors just comping it to some of the global peers. We've got Afterpay on kind of 60 times EV to gross profit, and then Zip's trading on like 30 times EV to gross profit. And you've got companies like Affirm in the US trading on kind of 25 to 30 times EV to gross profit as well. I think the interesting thing here for investors is Afterpay going to halve, or is Zip and Affirm and a couple of others going to double? I certainly think there's an opportunity here where we could see Zip start to re-rate closer towards where Afterpay is, as they seem to be winning the growth battle in the US, which I think is the key battleground at the moment for these buy now, pay later stock. And in particular, I think Zip's a much higher quality business. Yeah, okay, they don't turn their book as hard. Yeah, okay, gross margins aren't as high. But I think over the long run, backing a better run, more quality business is going to stand shareholders in good stead.
Now, Luke, you mentioned the US growth story there, and it's pretty phenomenal. QuadPay, Zip's US arm is just growing at a rate of knots. It'll be bigger than the Australian business soon. It already is on some metrics. Now there's talk about Zip listing in the US. Do you think they'll dual list, or do you think they'll move over to the US, and do you think that'll get them a better multiple?
Your AusBiz counterpart Nadine's constantly asking me about dual listings, and you'll hear that I'm not a fan of dual listings, and I've had many an abusive phone call with Larry talking about getting profitable and focusing on costs, which I think is really important for all businesses. But I do appreciate that potentially a US listing could be really attractive for fast-growing US-centric businesses like Afterpay and Zip. I think this recent sort of convertible note raise they did sort of points to the fact that maybe these companies are going to start looking more to the US as a source of capital. And I think as a result, it will probably be inevitable that maybe we do see a dual listing or a moving in listing, depending on how sort of big Zip gets over there. One thing I will say is that I've doubted and questioned Larry Diamond a number of times over the last 6 years or so, and I've been wrong every single time. So I've sort of learnt my lesson now, and I just sort of, he says something's worth doing, I just go, yeah, righto, Larry, no worries. I'll just.
So.
Oh, boy.
I just want to close out on that. Why do you think that Zip is trading on such low multiples compared to Afterpay? Like when we walked out of our interview with Larry last week, you know, they've got a lot going on, pretty significant sort of growth opportunities and a number of different parts of the business that I don't know if Afterpay are also doing. But like, what is driving this huge dislocation in value between the two?
From my perspective, it's simply so two important things in technology, and that's margins and scale. So, you know, margins in the first instance, just at a sort of a raw numbers basic level, you know, Afterpay is doing kind of 55% margins on every sale. So, whereas Zip's only doing sort of 45.
Right.
So I think that's probably the key difference, as well as obviously, you know, Afterpay is doing $900 billion in sales, Zip's doing kind of 400.
Yeah.
It's like half the size. So, you know, I think that both of those are significant factors for a lot of investors, but a lot of investors kind of don't necessarily get into the nitty gritty, and they just look at the headline growth rates and think, oh, a $1 billion business that can grow at, you know, 200% per annum, well, you're worth X in 4 years' time, so therefore I can pay up Y.
Yeah.
It's not necessarily that simple, but in the short term, that's how kind of a lot of market momentum investors can kind of look at things.
Yeah.
So, Luke, we could speak about Zip all day. I'm sure a lot of our listeners would actually love it if we spoke about Zip all day, but we're not going to. The next stock on your watch list is one that many people may not be familiar with. Vulcan Energy Resources, ticker VUL, $850 million market cap, and a good start to 2021, up a bit over 180%.
Jeez.
Can you, for people who are unfamiliar with the stock, can you tell us a little bit about what it does, and then why is it on your watch list?
Sure. So Vulcan are developing the first lithium, zero carbon lithium project in Europe, or in the world, but it's in Europe, in Germany. So essentially they're going to utilize a hot geothermal brine that has lithium in it, and they're going to use what's called direct lithium extraction techniques, using the power from the geothermal energy to create a zero carbon lithium product for the gigafactory market in Germany for the EV producers. So that's basically what they do. We met the company a bit over a year ago. We raised quite a bit of money for them at 40 cents. And then they've subsequently gone on a ripping run to where they are now. And like you said, an 850 mil market cap. A lot of people say the stock's run, this is over, it's a 800 mil market cap, how much more can it possibly go up? But I think that the pre-feasibility study that the company released late last year, shows this is a $3.5 billion project based on their current resource of 16 million tonnes. And they've got 1,000 square kilometres of license area, 1,000 square metres, of license area. And their JORC resource only covers a small fraction of that area. So there's significant scope for resource upgrade here, significant scope for increased pricing, and as well as acquisitions and cornering the market. And I do think that even though it's not in their numbers and it's not in any of the analyst numbers, these guys are going to attract a premium price for their lithium hydroxide product, and they're going to be in demand. So I really do see substantial upside here. Most of the lithium producing companies trade at a premium to NPV. If you want to talk about the sort of Pilbaras and Galaxies and Orocobras of the world, I do not see a reason why Vulcan won't be the same in production. You've only really got 18 months to wait from now. And I think that in the interim, you're going to see offtake deals and plenty of share price catalysts.
Speaking of catalysts, is the report that you just mentioned there the catalyst for the 180+% this year alone, or is that people just pricing in the potential for the stock? It's a pretty significant.
Yeah, it was wild. Like in the first month of the year, really, the stock was $1, $1.50, and $2, and the PFS came out. and it blew everyone's expectations out of the water. I mean, I thought it might be, if we were lucky, an 850 mil project. To put out a $3.5 billion number was just insane. And the share price got up to $14 at one point, and has really just pulled back since then. They just raised $120 million through Goldman Sachs just recently at $6.50. And that was multiples oversubscribed by a range of sort of high quality global institutions. Not talking about your local fundies here. I'm talking about globally significant ESG focused investors. So from my perspective, that's a business now that's full of cash, ready to go through to production, largely de-risked from a financing perspective. And if you know anything about what's happening with green bonds and funding green energy projects in Europe, these guys have got banks crawling all over them, looking to go there with the debt piece and get them through to production. So I don't see too much of an impediment or risk with respect to typical mining sort of project risk, which really are built around resource access and capital access, which Vulcan have really fixed both of those now. I actually think the stock's really still undervalued, even at $8 a share.
Wow. So, Luke, that's a really interesting company. My mind is blown that you helped them raise capital at 40 cents a share.
Yeah.
It would have been great to get in then.
Cheering.
We should have had you on the show ages ago. But we'll move on to the third and final stock for today's episode, and that's Adore Beauty, ASX ticker ABY, $340 million market cap. IPO'd in October 2020 and down almost 50% from its IPO price. Why is Adore on your watch list?
It's on my watch list because I think it's a really, really good business. And I know that's a sort of a funny thing to say for a stock that's down 50%, just missed earnings guidance again, had to downgrade again, really rocky start since it's listed. We weren't involved in the IPO, or we haven't taken stock in it. We've only just bought a few shares recently. But I really do see this as a potentially, a globally significant marketplace business. And the reason I say that is because there's such low penetration in makeup and personal care as a category relative to, say, on electronics. And I think whether you're talking about, this category or say homewares, for example, as the spend transitions from in-store retail traditional to online, there's going to be significant winners that come out of that. And we've seen examples in other categories and other sectors on the ASX and overseas where that's been the case. I think Adore has positioned themselves really well by creating a loyal niche kind of customer base. You only need to go onto their Facebook pages and social media to read the engagement they get from some of their customers. That's nothing, you don't get that kind of engagement on Coke. People like Coke cheap, and it's, you get what they need quickly. But Adore Beauty, they love the brand, they love the product, they love the bargains. The loyalty program is going to be a huge hit for this business. So while I've had a few kind of hiccups short term with growth and managing COVID and, and getting going on the ASX, I think there's a nice opportunity here at these kind of prices for investors to get set in what will be in my mind, a really long-term impressive company with, a range of different tailwinds.
Yeah, it's interesting you mentioned the downgrades there, and we know the significance of, downgrading, time and time again. What have been some of the drivers for those downgrades, and is it just a short-term blip? I mean, this business has been running for over 10 years now, so
over 20
over 20 years. Yeah. So how, it's not like it's just up and trying to find their feet. How are you thinking about that?
Yeah, I think, to be honest, it's really about managing sort of this funny COVID period for online retailers. A lot of them had sort of hockey stick growth on the back of shops are closed, got nowhere else to shop, and a nice stimulus check in my pocket. But I think the difference for Adore is that they had a tough period coming out as shops have reopened, and perhaps some of that spend has gone back offline, for lack of a better word. I don't think that's going to be a sustainable long-term trend. I don't think that people are shopping more in the shops now. I just think that perhaps they've gone back to Myers, they've gone back to DJs to buy their makeup because of the novelty of it, because they've been locked at home, because they haven't been able to go shopping. And I think that once we settle back into routine, then we should see, that growth start to stabilise and start to lift again. And I think Adore are more than cognizant they need to get their numbers up and be working hard to do so. But if you come off a base of telling investors that you're growing at 85% per annum, and then you come back, half later and say you're growing at essentially 0 or 10% per annum, your share price is going to get whacked. That's how it goes.
Well, Luke, unfortunately, that is all we have time for today, but thank you very much for coming on Equity Mates for the first time. Some really good insight there, so we would love to invite you back on at some point in the future to talk through maybe Afterpay this time instead of Zip.
I don't want to talk about Afterpay. I can't do it. I can't do it to myself. It still hurts me. So,
no, that's fair. That's fair. But appreciate you spending the time to come on, and we look forward to catching up in the future at some point.
My pleasure, gents. Well done. Speak to you soon.
Thank you. That brings us to the end of another episode of Watchlist Wednesday. As always, hoping that contributed some value to your investing journey and that you can add those stocks to your watch list. Head to equitymates.com for more information on what we're doing. You can email us any feedback as well to equitymates contact at equitymates.com.
Your mind is already on the birthday beers.
I'm
You're
looking
going to
forward
be
to some birthday beers. Yeah, I'll let you close it out, Rand.
Well, come join us tomorrow. Hopefully Bryce will be here, depending on how big the birthday beers are. But if Bryce isn't here, or if he is, we'll be talking about two, underreported on US tech stocks that we think are really interesting. So join us, same time, same place tomorrow.
See you then, maybe.
Equity Mates, from our mates at Spaceship. Investing made easy.